Today, we're digging into some huge news from the food world. Kraft Heinz, yep, the company behind the ketchup on your fries and the mac and cheese in your pantry, is splitting into two. We're going to break down why one of the biggest food giants on the planet would decide to get smaller on purpose. But first, we have to get the important disclaimer out of the way. What you're about to hear is an explanation of a corporate announcement based on what the company itself has said. This is not, and I mean not, financial or investment advice. Our only goal here is to understand the what, the why, and the how behind this massive decision.
And really, that's the big question, isn't it? Kraft Heinz is an absolute behemoth, so why on earth would a company that big decide to just break itself apart? The answer gets at a classic business problem: what happens when you get too big to succeed?
To really get the logic, we first have to look at what was actually announced.
So, on September 2nd, 2025, the plan officially dropped. Kraft Heinz is going to become two completely separate, publicly traded companies. And let's be clear, this isn't some minor reshuffling of departments. This is a fundamental redesign of a food empire.
So what's the thinking here? I mean, a move this big has to be the solution to an equally big problem, right?
While the executive chair, Miguel Patricio, basically said it himself, he explained that the company's sheer complexity makes it hard to allocate capital effectively. In plain English, that means when you're juggling everything from ketchup and cream cheese to hot dogs and lunch meat, it's just really hard to know where to put your money to get the best results. Their own massive size was actually starting to hold them back.
So this split is the proposed solution. The whole idea is to achieve three things. First, give each new company way more focus on its own brands. Second, just straight up reduce the complexity of running the business. And third, allow for customized capital allocation. That's just a fancy way of saying each company can spend its money on what it needs. So the grocery company might invest in new factories in the US, while the global one pours cash into marketing in Asia. Different needs, different strategies.
So what will these two new powerhouses actually look like? Let's meet them.
Now, the magic number that makes this all work? 3. That's the number of billion-dollar brands that are going to anchor each of the new companies. The idea is to make sure that both of them are total heavyweights right from day one.
Okay, here's the breakdown. On one side, you're going to have Global Taste Elevation Co. This is the bigger piece, built around huge names like Heinz Ketchup, Philadelphia Cream Cheese, and Kraft Mac Cheese. You can think of this as the global sauces and comfort food business. On the other side, you get North American Grocery Co. This one is anchored by brands like Oscar Mayer, Kraft Singles, and Lunchables. This is your classic American refrigerator filler. So two very different companies with two very different missions, all coming from one single giant. So how do you actually untangle a company this massive? As you can imagine, it's a long and complicated road.
Yeah, this is definitely not happening overnight. They made the announcement in September of 2025. But the whole thing isn't expected to be fully closed and done until the second half of 2026. There are tons of regulatory hoops to jump through and filings to make before these two companies are officially flying solo.
And, of course, a corporate divorce like this isn't cheap. The company expects to lose up to $300 million in efficiencies. They call this dis-synergies. Basically, that's the cost of creating two separate headquarters, two IT systems, two supply chains, all that stuff. And while they say they have a plan to lower that number, that's still a huge bill to pay for independence.
So after all that cost and all that complexity, what's the end game? What does success actually look like here?
For shareholders, the company's making 4 key promises. First, the whole split is designed to be a tax-free deal for them. Second, the total dividend paid out across both companies should stay the same as it is now. Third, both new businesses are going to aim for strong investment-grade credit ratings to show they're financially stable. And finally, we know who's in charge. The current CEO, Carlos Abrams-Rivera, will take the helm of the new North American Grocery Co.
And all of this leaves us with the one big question that's hanging over this entire strategy. Kraft Heinz is making a massive bet here. They're betting that focus will beat scale, that two smaller, more nimble companies can ultimately create more value than one complex giant. Now the market, the consumers, and all their competitors will be watching very closely to see if that bet pays off. Only time will tell.